So you're going to want to write this down. There are only 5 ways to save taxes. Only 5. I'm going to give you all 5, and then we're going to talk about his question. The first is deductions. Most of you are aware of deductions because you've taken some deduction, either a business deduction or a personal deduction sometime in the past. Now, conversion. We went through this. You're converting it to better income. Ordinary income to capital gain. Okay? Ordinary income to tax-free. That's converting it to a type of income that's not taxed as much. Okay, that's conversion. The third one is tax brackets. Now we have what's called a progressive income tax, which means that everybody, including Warren Buffett, has a low tax bracket that they get to use every single year. How many of you have children? How many of you have parents? Okay, so covered most of you. Your children, so 200 years ago, people wanted to have children because they wanted laborers on the farm, right? They were assets. Okay, either they wanted boys to work on the farm, they wanted girls to marry the boys who worked on the farm, right? So seriously, I mean, 200 years ago, that was our society. Now we're in the information age. Children, are they assets or liabilities? That's a question. People ask themselves all the time. But your children and your elderly parents have something that I would call a underperforming asset. And it's a tax bracket. Your children have tax brackets. Now the first $12,000, we have this new standard deduction, which is fantastic. It's $12,000 per person. And your children each have one. And if you're not using that, that's a non-performing asset in your portfolio. So the easiest way to take care of that is to employ your children in your business. Since most of you are business owners, it's pretty easy. Up to $12,000, completely tax-free to them and deductible to you, as long as they're worth it.
How old do they have to be?
They have to be worth it. Okay, so I will tell you, I've known 8-year-olds who are worth way more than a 14-year-old.
What about an 8-month-old?
Wait a minute, don't be so quick on that one. You guys are in a business where you serve primarily families. Children, especially 8-month-olds, make great models because they don't know enough yet to pose. So they're cute as a button. And they make great models. And child models get paid good money. So there's no reason you can't pay that 8-month-old. You have a custodial account. Now, you have to pay them a fair wage, okay? It can't be too much, right? It's got to be the same price as if you went out and hired another 8-month-old. What would you pay that other 8-month-old? You can't pay more than that, all right? It has to be, that's part of the ordinary, typical amount, right? It's got to be typical. So, but you got up to $12,000 tax-free. You've got another $99,000 after that that's at 10%. So you got like $22,000 at this like teeny tiny rate. And if you don't have kids and you're supporting your elderly parents, why can't you involve them in your business? But it gets even better. So people always ask, what about child labor laws? They don't apply to your own children. Apparently. That's what the lawyers tell me. They don't apply to your own children, which is awesome. I've employed both my kids at times, and sometimes they were worth what I paid them, and sometimes not. But think about the government policy behind it. See, if you can start thinking about why these rules are the way they are, then you can get over this whole idea of, well, I feel guilty if I don't pay tax. How many of you believe that it would be good for the government if your children learned how to work? Raise your hand. How many of you believe that it would be good for your business if your children actually helped you with the business? Raise your hand. Okay? So the government has an incentive, policy-wise, to incentivize parents to employ their children in their own businesses. So they give these incentives. One of the incentives, by the way, is if your child's under the age of 18 and you set it up properly, you don't even have to pay Social Security tax on that money. Those kids are exempt by law. Does that sound like that's something the government doesn't want you to do? No. The government clearly wants you to do that. They're giving all sorts of incentives for you to do this. There's lots of ways to take advantage of of those tax brackets, but paying your kids, probably the easiest one. I was in South Africa a year ago, and I have a South African chartered accountant, their equivalent of a CPA, on stage, and she's really smart. And I said to her beforehand, I said, so in South Africa, if you employed your kids, could you pay them and get a deduction for it? Yeah. Would they pay tax on it? Well, at their bracket. And she goes, I never thought of that. So, and she's really smart. But you can do it all over the world.
The end benefit of that is that you take your college expense for those kids and you can reduce it by 30-40%. You would have paid income tax on that money anyway, right?
Gets better.
4 and 5.
No, it gets better. I'll get there. I haven't forgotten about you. Could your kids take that money and invest it in your real estate portfolio? Yes. Could your kids, you just paid them $12,000. So here's your child. They're now going to invest $12,000 into real estate. From their custodial account, or even better, their trust account. Okay, I prefer trust accounts, but either their custodial account, which who controls that? You do. A trust account, though, custodial account, once they turn 18, you don't have any control anymore. You have to give it to them. If it's a trust account, you can control it after you die. So trusts are awesome. Whole nother story. But why not this? Here's your college savings plan right here. You guys have an inside track on real estate. You're never going to pay tax on this. And you're messing around with a 529 plan? Are you out of your freaking minds? Tax-free income, not tax deferred. All right, speaking of which, let's go to the other two. I promised you guys. Okay.
What about the parents?
Parents are even better. Parents, you don't even have to pay them. You just give them a share of your company. It's easy. Just give them a share of your company. They get non-voting shares. You don't want, and then what, of course, now, okay, little caveat here. Make sure that in their will, you get it back. Or, even better, just put it in the operating agreement that when they die, you get it back. Okay, so some way or another, you got to make sure you get it back, because you probably don't want your siblings. Most of us don't want our siblings involved in our business. I know I don't. But my siblings are all richer than I am, so it's actually okay. I would be okay involved in their business. But you can actually give it to your parent. You could actually give them a share, and then you don't have to pay them. They don't have to work at all, and they still get their tax. Kids don't get a tax bracket if you give them a part of your business. They only get their tax bracket if you pay them. Whereas parents get it if you're over 20, 21, 24, if you're a student. If you're not a dependent age anymore, then you get a tax bracket regardless. You know, earned income or unearned income. Parents get it when it's unearned, and kids only get it when it's earned. Okay. All right. So fourth way is what we call elimination. And we were just talking about this. And this is non-taxable income or tax credits. You're just completely eliminating it, okay? So a credit is dollar for dollar, whereas a deduction depends on your tax bracket. So credits are always better. But it can be, but there's low-income housing credits, there's historical housing credits, there's electric vehicle credits, there's adoption credits, there's all sorts of credits, okay? And then there's like life insurance, which is non-taxable all the way around. So life insurance is a perfect example of elimination, okay? Or you could actually go back to our diagram here. And do buy, borrow, die. And that's elimination, because you never have to pay a tax on it. The last one, so after we've done all of that, if we have no other choice, we defer. So if we have, these are all permanent tax benefits. Okay, so the subtitle of the book, this is tax-free wealth. By the way, it's not tax-reduced wealth. It's tax-free wealth. Okay, so I'll give you an example. I have a doctor client. Doctors are really tough to deal with, well, for a number of reasons. But they're particularly tough to deal with from a tax standpoint because they have a lot of restrictions on them from a tax standpoint. But we, within 3 years, because of what he's doing, all I did was tell him what to do. He had to do all of it. Because of what he is doing, within 3 years, he will be tax-free. And he makes over $1 million a year. Okay? So it's very doable. But the subtitle is How to Build Massive Wealth by Permanently Lowering Your Taxes. Okay? So this is temporary. All of these are permanent. So this is, by the way, deferral. Out of that 6,000 pages is 400 pages of the law is deferral. So that means there's 5,600 pages of the law, roughly, that is permanent tax savings. So my question is, why is your accountant focused on deferral? Because this is where most accountants go. And I'll tell you, it's actually, there's a reason for it. You want to know? Yeah. There's 2 4-letter words. The first is, because it's easy. How much easier is it than to say max out your 401k? And the other reason is because they're lazy. Because reading the tax law is hard. Studying the tax law is hard. Okay, it takes a lot of hard work. Okay, reading 1,000 pages of the new tax bill, which my wife and I did on vacation in Hawaii a couple of years ago, is hard work. But let me tell you, it's nice when the clients have, when I get people coming up to me and say, not only did you reduce our taxes from $400 to $45,000, but it saved our business. Then it's worthwhile to not take the easy route.